real quiz for you real quick. You guys all, how many have like dozens of these things? You know, little thumb drives. Right? This one happens to be a 16 gigabyte thumb drive. Who would like to buy this back in 1980? You know what this thing cost in 1980? You couldn't buy this particular item, but you could buy this amount of memory. How much would it cost to buy 16 gigabytes of memory in 1980? Throw a number at me.
$10,000.
You're way low. Extremely low. Keep 1980. So you're still way too low.
10,000. 10 million.
I got, hey, you're actually closer. It was on average $500,000 per gigabyte. This is 16. So this would be $8 million. What does it cost today? About $1. Right? That's actually one of the benefits of inflation, but it doesn't sound like it. But we get to buy today 16 gigabytes worth of memory for $1 versus 16 gigabytes worth of memory for $8 million 40 years ago. How is that possible with inflation? Right? We're going to talk about that just for a little bit. So inflation, is it our savior or our villain? That's my subject. Does it help us or hurt us? Well, doesn't it kind of depend on which side of it you're on? Yeah, depends on which side. So how many would love to buy our electronics today with today's money versus 30 years ago, right? Our phones, computers, everything. However, our houses 30 years ago, what did they cost us? Yeah, there were 30,000 of our houses very much available. I bought my house in 2005. If I had to buy it today, I'm not sure I could. Just because that's what's happened with inflation. So we don't really, it depends on what side of the equation you're on. Now, what is inflation? I can tell you that it's absolutely necessary. Who here loves inflation? I'm not getting any hands up. Oh, darn. Parker is because he's my assistant and I pay him. Who here loves inflation? Okay, thanks, Glenn. Appreciate it. Well, again, it kind of depends. A moderately increasing inflation is actually a great thing. Why? Because it brings price stability. I know that I'm going to pay just incremental amounts more every single month or every single year, so I'm going to make my purchase today. I'm going to go out, if I need to buy something, I'm going to buy it today because I know a year from now it's going to cost me more. Right? However, I don't like hyperinflation. That's what causes bubbles. And when a bubble forms, it's like running off a cliff. You hike and hike and hike, and the cliff's in front of you, you can't see it, you don't know, you know it's there, but you can't see it, and next step you take, you're off a cliff. That's the problem with bubbles. We've had a couple of big market bubbles over the last 20 years. Who remembers the dot-com business? 1990s, right? And then it burst. We had, this black line is unemployment. The blue line is inflation. We saw some strong inflation, bubble burst, and unemployment goes up. Market tends to correct itself over time. And then we had it again. And this bubble here in random 2009, 2010, what was that bubble?
Housing.
Yeah, housing. Yeah, we had some crazy things going on back then. You could buy a house with no documentation whatsoever, with great rates. It was crazy, right? So what happened? Bubble burst, unemployment goes up, inflation comes back down. That's what we don't like to see. Federal Open Market Committee, Feds. You guys are familiar with Feds? They control our short-term interest rates. They don't control mortgage rates. They control our short-term rates. They're trying to control inflation to about a 2% level. This here, this darker blue line is the inflation line, what's known as CPI, Consumer Price Index. If you want to track inflation, look at the Consumer Price Index. That's what will tell you. And this is the Fed funds rate, how they move it. One of the problems is during these periods of deflation, where inflation goes too low, the Feds go to 0% interest. Is there anything lower than 0? No, they have very limited ammunition to fight deflation. What's the problem with deflation? Doesn't it sound like great? Hey, my prices are getting cheaper.
You wouldn't buy a memory stick without it.
You would? Well, see, but I don't know. We'll just talk about that first, briefly. The problem with deflation is if I know I get a cheaper price tomorrow, what I make the purchase today. What if I know I'm going to get a much cheaper price a year from now? Would I keep delaying that purchase? What happens to those who manufacture stuff? If I keep hoarding my money and I don't spend it, what happens to the manufacturers? They go out of business. They lay off, and then you get demand destruction, right? No, people stop demanding stuff, so you get more unemployment, less demand, more unemployment, less demand. It's a vicious cycle. Deflation is what leads to recessions. Now, a little bit of deflation is okay. If I can increase my purchasing power and it's short term and it's over a few little things, it's fine. But big deflation is a real problem. And that's a problem for the Feds. They will fight deflation vigorously, much more so than they will fight inflation. Now, and that's the point of this, is when you see 0% interest, they got nowhere else to go. So they have to raise rates eventually, just to give themselves back some ammunition. Now, who's heard of stagflation? Who remembers the 70s? Glenn was through the 70s. Brian does? Yeah. What did President Nixon do in 1969?
Wage and price control.
Wage and price control. And it was disastrous. But it also won him a re-election. People cheered in the streets and danced the streets. Hey, wage and price controls are going to be fixed. They have to get permission to raise prices. They have to get permission to raise wages. How did that work out? It was disastrous. So 1972, we start to see the black line again is unemployment. Unemployment goes to 10% in the mid-70s. Again, we see almost 10% in 80s. What was the worst of the unemployment during the housing crisis? It was about the same. It was right at 10%. Back in the 70s was just as bad as unemployment rate as it was, and we were all crying in our milk for years after that, right? So what did the Feds do? They raised interest rates all the way up to 10%. Actually, that's correct. I'm looking at inflation rates. I can go to the next chart. There, what did they do? They raised the funds rate all the way up to 14 to 15%, just to try to get ahead of the inflation. But the problem with stagflation is you have rising costs and rising unemployment. You actually have supply destruction. The suppliers don't want to give you anything because they can't make their money. Because they can't sell you stuff, they have to lay off all their people. So you have rising unemployment and rising costs. It's the worst of everything. But that's what, when Reagan was elected, he put a new Fed chair in and they raised rates dramatically quickly. And that's how they got in front of it. But if you look at the Fed funds rate, it went into double digits. I'm going to give you a few historical things here. Back in the 80s, who remembers interest rates in the 80s? Mm-hmm. Highest mortgage rates topped out around 18% interest. Woohoo! Who wants that one? Okay, my rates tomorrow are 19% interest. Who's showing up? Nobody? Yeah, crazy, huh? But that's what happened. You can see the blue line is in the funds rate. You can see that these two kind of track each other, but again, the rate that the Feds control do not really control mortgage rates. See, they're not really that tightly correlated. Mortgage rates are all controlled about inflation and investors. And I'm going to let Aaron talk a little bit more about push and pull inflation measures.